Okay, we're going to go over the life insurance pre licensing course, and I'm going to just read this to you so you can listen to it at any time. The materials can be sent to you or whatever. Anyway, so here's the audio of it all. Uh, so basically, this is for the Kansas Life Insurance Test. Kansas Life Insurance is mandatory certification for individuals who wish to sell or advise on life insurance products within the state of Kansas. Our state, the Kansas Insurance Department, or that's called KID, KID, is responsible for overseeing the licensing process, ensuring that all candidates meet the necessary educational and legal requirements before becoming insurance agents. As a licensed agent, you will be qualified to sell various life policies, including the life insurance policies that provide financial benefits to beneficiaries in the event of the policyholder's death. Annuities, final products, or financial products that provide periodic payments, often used as a retirement income tool. With the annuities, you're going to have to get another certification. But we're mainly focusing on life insurance here. But these things will be on the exam that you'll have to take. Being well versed in both Kansas state laws and the fundamentals of insurance is crucial for passing the exam and obtaining your license. This chapter will provide an overview of examination process, licensing requirements, study strategies, and everything you need to prepare for success. The examination process. The Kansas Life Insurance License Exam is administered by Pearson VUE, VUE, a trusted provider of computer-based testing. The exam consists of two main sections. General knowledge. This section tests your understanding of insurance principles, types of insurance policies, and policy provisions. Kansas state insurance laws. This section focuses on Kansas-specific insurance regulations, licensing laws, and ethical standards. Key details of the exam include format is the multiple choice questions. Duration, typically the exam is about 2.5 hours, and you must have a passing score of 70% or above. After passing the exam, candidates are eligible to apply for their Kansas life insurance license through the KID, or Kansas Insurance Department online portal. Study strategies. Preparing for the Kansas Life and Health Insurance License exam requires a strategic and organized approach. Here are some key study strategies to help you succeed. Understanding the exam online. Review the detailed exam contents online provided by Pearson VUE. Do that. Just go to their site. Have a bunch of stuff on there. To know what topics will be covered in each section, focus your study efforts on both general insurance concepts and Kansas-specific laws. Create a study schedule. Set a study plan that allocates sufficient time to cover each topic thoroughly, breaking down the material into manageable sections, and study consistently over a period of weeks rather than cramming for it at the last minute. Use multiple study resources. Leverage textbooks, online study guides, and practice exam. You can also Google most of this stuff and build an understanding, okay, to know this stuff better. Kansas-specific study materials are essential for understanding local regulations. Practice with simple questions. Completing practice questions is crucial. Not only does it familiarize you with the exam format, but it also helps you identify areas where you may need further review. Stay organized. Keep notes, flashcards, and summaries for each topic. These will be helpful for quick reviews before the exam. And you can join study groups. If possible, collaborate with others who are preparing for the exam. This allows for discussion and clarification of difficult concepts. Licensing requirement and procedures. Become a licensed life insurance agent in the state of Kansas. Candidates must meet the following requirements. Pre-licensing education. Now, okay, if you go to the Kansas site, you'll also notice that you can do self-study. So some things do change, all right? Kansas requires candidates to complete a state-approved pre-licensing course. Not so much. You can do this self-study, okay? These courses can be taken online or in person and typically cover the foundational knowledge required for the exam. So you can actually do it on yourself, or you can pay for these courses. And some of them like 99 bucks, 150 bucks. I've seen it at 200 and some dollars. I've seen all sorts of prices. But just come here and you get it for free. Pass the exam. After completing the pre-licensing course, candidates must pass the Kansas Life Insurance exam. This is the most significant step in licensing process. And you must submit fingerprints. Kansas requires all applicants to submit fingerprints for a background check before being granted a license. Okay, but you could still take the exam without it. But be aware, if you have some issues, get some of those things expunged, and then do the fingerprinting and all that stuff. So sometimes it could take some time putting something together. Okay, this is done to ensure that applicants meet the state's ethical and legal standards. Application submission. Once you have passed an exam and completed fingerprinting process. Oh, by the way, it's not my text, but I have to change it. You have to get a tax certificate in the state of Kansas to that you paid your taxes, that you're up to speed on your taxes. Okay. So, you can apply for the license through the National Insurance Producers Registry, or NIPR, or Kansas Insurance Department, KID. Remember, be prepared to submit the required fees and documentation. Continuing ed. By the way, you have continuing ed. After becoming a licensed agent, must complete ongoing continuing ed. Usually, Kansas gives you 4 years, and then after 4 years, you have to do CEs, and that is 24 hours, and 3 hours of it must be in ethics, by the way. And it's not a big deal. That has to be through a provider, and it's maybe 50 bucks. Okay. So a CE is required to maintain their license. This ensures that agents stay updated on industry changes and regulations. Exam registration process, by the way. To register for the Kansas Life Insurance License Exam, follow these steps. Complete the pre-licensing education. We just talked about that. All right. You can do it online, or you can do it here for free. Online, you have to pay. Or you can go to a class. There's several places in major cities. So, like, for example, you can go to AD Banker and pay them and sit in a class. Try to stay awake. Okay. I didn't mean that, but that's where I took mine. Maybe I wasn't back in 97. So who knows? Who knows what it's like now, right? Maybe they keep you awake. Maybe throw ice at you or something. I don't know. Before you can register for the exam, you must complete the mandatory pre-licensing education course. Not so. Okay. Like I said, you can do it self-study in the state of Kansas. Some states, like Ohio, you have to do a 20-hour course and pay. Okay. Register online with Pearson VUE. Go to the Pearson VUE website, create an account, and select the Kansas Life Insurance License Exam. Make sure you just do Kansas Life. Don't pick Life and Health. If you pick Life and Health, you'll be taking the test for Life and Health, and we're not going over the health insurance aspect, and so you'll probably fail. Okay, careful, be aware. You can choose a convenient date, time, and location for your exam. Pay the exam fee. The exam fee must be paid at the time of registration. Be sure to check the Pearson VUE website for the most current fee schedule. Receive confirmation. After registering, you will receive a confirmation email with details about your exam, including the testing center's location and exam time. By the way, you might be able to take it like at a library, or, anyways, there's some options there. You'll see. Be prepared. Prepare for the day of exam. Gather all required identification and materials needed for the exam day. Okay. What to expect on the exam day. Knowing what to expect on the day of your exam can help reduce anxiety and ensure a smooth process Here's what you need to know. Arrive early, 30 minutes early. Okay. Plan to arrive at the testing center at least 30 minutes before your scheduled exam time to allow time for check-in. Bring proper identification. You must bring 2 forms of identification, one of which must be a government-issued photo ID, like a driver's license or passport. And make sure that it's not expired, okay? The second can be a credit card, social security card, or a utility bill with your name on it. I know some people, maybe they're living at home still and they don't have a utility bill, but just bring your social security card, because you probably don't have a credit card yet. Okay. Now, let's see. It's a credit card, didn't say debit card. It's a credit card. Testing environment. The exam will be administered on a computer in a quiet testing room. You'll be provided with a calculator and scratch pad if necessary. Personal items like phones, bags, and notes are not allowed in the testing area. And actually, be quiet too while you're in there. Don't make a lot of noise; they'll kick you out. That wouldn't be good. Okay, because there are other people in there doing other tests. There's Pearson VUE does more than just a life insurance test. They do lots of different tests. Check-in process. At check-in, you will be asked to verify your identity and sign in. Pearson VUE testing centers may also take your photograph for security purposes. So, comb your hair, if you want to shave. If you want to put lipstick on, whatever you want to do, but be aware they'll probably take your picture. During the exam, you will be seated at a computer station, and the exam will be presented in multiple choice format. You can navigate between questions and flag items for your review later. Take your time, but be mindful that the clock is ticking. It's 2.5 hours for you to ensure you answer all questions. Okay. After the exam, once you complete the exam, the score will be provided immediately. If you pass, you will receive instructions on the next step for applying for your license. If you do not pass, if you do not get a 70, if you get like a 68, boo-hoo, right? No, you can receive feedback on which areas you need to improve and prepare to take it again. So go do the steps again through Pearson VUE to reschedule a test and everything else. If you have questions, feel free to contact me and I'll try to help you through it. Okay. So here we go. Kansas insurance laws and regulations. Kansas insurance law provides the foundation for all insurance-related activities in the state, ensuring fair practices, consumer protections, and industry compliance. Overview of Kansas insurance law. Kansas insurance laws regulate how insurance companies, agents, and brokers operate within the state. Their primary goal is to protect the consumers while ensuring a competitive and fair market for insurance providers. These laws establish standards for the licensing of agents, outline policyholder rights, and regulate the sale, replacement, and advertisement of insurance products. In Kansas, all insurance practices are governed by the Kansas Insurance Code, KSA Chapter 40, which covers everything from general insurance principles to specific mandates related to the life insurance. The Kansas Insurance Department, KID, is responsible for enforcing these laws and ensuring that all industry participants adhere to the state's legal and regulatory requirements. The state of Kansas, or KID structure and role, ROLE. I'll try to say it better. KID is the regulatory authority responsible for overseeing the insurance industry in the state. It was established in 1871. KID's mission is to enforce Kansas insurance laws, protect consumers, and maintain a fair and competitive insurance marketplace. Key responsibilities of KID. 1. Licensing. KID handles the licensing of insurance agents, brokers, and insurance companies operating in Kansas. 2. Consumer protection. The department investigates consumer complaints related to the insurance practices and takes appropriate disciplinary action when needed. Oh, please. Just do the right thing all the time. Okay. You won't be in trouble. 3. Regulation and enforcement. KID enforces state-specific insurance laws and regulations, ensuring that the companies comply with Kansas Insurance Code. 4. Market conduct. KID conducts market analysis and audits of insurance companies to ensure their fair pricing, ethical ethical sales practices, and appropriate claims handling. KID organizational structure, by the way, Commissioner of Insurance. The head of the KID department, or Kansas Insurance Department, appointed by the governor. The commissioner oversees all regulatory functions and serves as the primary spokesperson for KID. Divisions within KID is organized into various divisions, such as handling specific aspects of regulation, including Consumer Assistance Division, Licensing Division, Market Conduct Division, Legal and Enforcement Division. Key regulatory concepts. To ensure compliance with Kansas insurance laws, agents must understand several key regulatory concepts. 1. Solvency requirements. Insurance companies must maintain adequate reserves to meet future policyholders' obligations. 2. Unfair trade practices. Engaging in deceptive advertising, misrepresentation, or unfair claims handling is prohibited. 3. Suitability. Insurance products must be suitable for policyholders' needs, with agents required to provide appropriate recommendations based on their clients' financial situations and objectives. 4. Market conduct. Kansas law mandates that all insurance companies and agents follow ethical practices in advertising, claim handling, and policy issuance. Some of these things are going to be redundant, so I'm sorry for that. It's just the way this is written. Licensing requirements. In Kansas, individuals must meet specific licensing requirements to sell life insurance. These include pre-licensing education. There we go again. Candidates must complete an approved pre-licensing education course covering life insurance concepts and Kansas specific laws. You can do self-study. Look it up. It's on the Kansas site. Kansas Insurance Department, you'll see it on there. Like I said, some states require that you go through a specific course structure, but Kansas does not. And state of Missouri as well. So far, as of today, this is like 2025, the year 2025. Passing the licensing exam. After completing pre-licensing education, candidates must pass the Kansas Life Insurance License Exam. The exam is administered by Pearson VUE. I think we just talked about that, didn't we? Application submission. After passing the exam, candidates must submit application along with applicable fees to KID. Okay, we did that. Background check. Kansas requires background checks, including fingerprinting, to ensure the candidates meets ethical and legal standards. I think we said this before, didn't we? It's craziness. Why don't we say it again and again and again? Maybe so we can memorize it, right? Okay, so remember, maybe we didn't say this before, but continuing education requirements, or CEs. Once licensed, agents must fulfill continuing education requirements to maintain their license and stay updated on industry developments. Right? I think we did talk about this before. So you have 4 years in the state of Kansas. You have 4 years after you pass your exam, your first time. When first time you get your license, okay, you have 4 years, and so then your continuing ed is every 2 years, and doesn't cost so much, maybe $50, maybe less than that. It depends on what you pick. Okay, but total hours, Kansas requires agents to complete 24 hours of continuing ed every 2 years. Oh, I think I just said that, didn't I? Ethics training. Of the 24 required hours, at least 3 must be in ethics training. Life-specific CE agents licensed for life insurance must complete a portion of their CE related to these fields. Make sure you pick the right thing. One time I picked for financial advisor, or yes, financial advisor. No, what was it? For some, what was it? It was for something else. I didn't pick the right one, and I had to get what to retake my CEs. Oh my gosh, it was terrible. So make sure you pick the right thing. Okay. Provider approval. All continuing education courses must be approved by the Kansas Insurance Department. Now that's true. So you can't self-study that. On CEs, you got to go through a provider approval. Okay. Reporting agents must submit proof of CE completion to KID, typically through the course provider. Yeah, it's automatic. and they'll give you, you can get a copy. I would recommend you save a copy and keep it in your records. And then also it should stay at that provider's website. Mine are a list of them. Failure to complete CE requirements can result in license suspension or revocation. Don't just do your CEs if you want to stay in business. Okay. Disciplinary actions and penalties. The Kansas Insurance Department, KID, okay, has the authority to impose disciplinary actions and penalties against agents and companies that violate Kansas insurance laws. Obvious. Yes, common violations include fraudulent insurance practices, intentionally deceiving policyholders or insurance, unethical sales practices, misrepresenting products, or engaging in pressure tactics. You must buy. I'll hold them by their throat right now. Don't do that. Failure to comply with licensing requirements, not completing CE requirements, or operating without a license. Yeah, don't operate without a license. Get in trouble with that. Or if it's revoked or something like that, get it cleaned up before you start doing something else, okay? Before you start doing this stuff. Don't want to lose it to where you can never get it again. All right. Consumer complaints. Actions resulting from policyholder complaints, such as mishandling claims or misleading clients. So don't mislead anybody. Just tell the truth. Possible penalties include fines. Monetary penalties can impose for minor infractions, license suspensions, or revoke you. Serious violations may result in the suspension or permanent revocation of agent's license. Probation. Agents may be placed on probation and required to follow specific corrective actions. Kansas specific laws for life insurance. Kansas has several laws and regulations specific to life insurance, which agents must follow. 1. Replacement rules. When replacing an existing life insurance policy, agents must provide a written comparison of the new policy's features and benefits versus the old policy. This ensures that consumers are making informed decisions. 2. Disclose requirements. Agents must provide full disclosure of potential policyholders regarding the terms, conditions, and limitations of the policies they are selling. Failure to disclose important details can result in legal action. Replacement and disclosure rules. Okay, Kansas has strict regulations regarding the replacement of existing life insurance policies. These rules are in place to protect consumers from making uninformed decisions and from unnecessary policy replacements. When a policy replacement is proposed, agents are required to provide a replacement notice. This notice explains that the consumer is replacing an existing policy and outlines the consequences of doing so. 2. Disclose of comparison. Each agent must provide a side-by-side comparison of new and existing policies detaining premiums, benefits, and any applicable surrender charges. 3. Maintain documentation. Agents are required to maintain copies of all replacement-related documentation for a specific period. Just keep everything forever. For as long as you have your license and you have a drawer full of stuff, okay? Advertising requirements. Kansas insurance laws regulate the advertising practices of insurance agents and companies. Advertisements must be truthful, non-deceptive, and must not misrepresent the terms, conditions, or benefits of the policy. Prohibited practices. Misleading comparisons between policies, unsubstantiated claims about policy performance, omitting critical policy details. 2. Compliance and standards. All advertisement, whether in print, online, or broadcast media, must comply with the state standards set by KID. 3. Disclosure in advertising. Advertisements must clearly state the insurer's name, the nature of the policy, and any limitations and exclusions. Policyholder rights and protections. Kansas provides robust protections for policyholders, ensuring that insurance products are sold ethically and that claims are processed fairly. Some key policyholders' rights include free look period. Policyholders have the right to free look period, typically 10 to 30 days, during which they can cancel policy for a full refund. 2, grace periods. Kansas requires insurance companies to provide a grace period for missed premium payments, giving policyholders extra time to make payment before their policy lapses. Wonder if you're on vacation or out of country, you oh my gosh, I forgot to pay. I want to get that figured out, right? Timely claim payment. Kansas law mandates that insurance companies must process and pay claims within a reasonable time frame. Delays in claim payments can result in penalties. Consumer complaints. Number 4, policyholders have the right to file a complaint with KID if they believe they have been treated unfairly by the insurance company or agent. I would say in broker too, but it says it right here. Okay, I'm going to take a little break. I got to get some water. I will be right back. Okay, I'm back. Put my hat on too. My son got me this hat for Father's Day. Love it. Especially the Kansas sun. Really make you burn your face off, right? So we're going to talk about general insurance concepts, definition and purpose of insurance. Insurance is a financial mechanism designed to provide protection against the financial impact of unforeseen events. It involves the transfer of risk from an individual entity, the insured, to an insurance company, the insurer, in exchange for regular payment known as premiums. The purpose of insurance is to safeguard individuals, businesses, and organizations from significant financial loss by providing compensation in the event of covered losses such as death, illness, or property damage. The primary objective of insurance includes risk transfer, transferring the financial burden of potential losses to the insurer, risk pooling, combining the risk of many policyholders to make losses more predictable and manageable. Financial protection, ensuring that individuals and businesses are financially protected against catastrophic losses. Risk management principles. Risk management is the process of identifying, assessing, and prioritizing risks, followed by implementing strategies to minimize the likelihood or impact of those risks. In the context of insurance, risk management helps individuals and organizations mitigate the financial consequences of unforeseen events. Risk management strategies include risk avoidance, taking actions to avoid risk entirely. For example, an individual may avoid driving to reduce the risk of car accidents. Or 2, risk reduction, minimizing the severity or likelihood of a risk. An example is installing a fire alarm to reduce the risk of fire-related damage. 3, risk retention, accepting the risk and being prepared to cover the losses. For example, or for instance, individuals may opt to pay for minor health care costs out of pocket instead of purchasing insurance for minor incidents. 4, risk transfer, shifting the risk to another party, such as an insurance company. Purchasing an insurance policy is the most common form of risk transfer. Risk sharing, distributing risk among multiple parties. Health insurance pools, for example, distribute healthcare costs among all insured members. Types of insurance providers. Insurance providers come in various forms, which its own structure, purpose, and operating model. Understanding the different types of providers is essential for both agent and policyholder. Sorry about the hat, kind of gets in the way of my eyes, doesn't it? I don't know. Oh, love my hat. Okay, essential for both agents and policyholders. Stock insurance companies. These companies are owned by shareholders who invest in a company by purchasing stock. Shareholders may receive dividends based on company's profits. Sorry. Stock insurance companies operate with a primary goal of generating profits for shareholders. My water. Mutual insurance companies. Unlike stock companies, mutual insurance companies are owned by policyholders rather than shareholders. Profits are often returned to policyholders in form of dividends or premium reductions. Mutual companies prioritize policyholders' interests as policyholders are essentially co-owners. Fraternal organizations or fraternal benefit societies or nonprofit organizations provide insurance to their members. They are typically based on common affiliations such as religion, ethnicity, or occupation. These organizations offer life and health insurance as part of their benefits packages to members, but they must follow the regulations of the insurance industry. And self-insured. Some large businesses or organizations choose to self-insure, meaning they assume the financial risk of potential losses rather than purchasing insurance from an external company. Self-insurance is more common in large companies that have financial resources to cover the risk internally. Stock versus mutual companies. Understanding the key difference between stock and mutual insurance companies is essential for insurance professionals, as these differences affect how policies are structured and how profits are distributed. Stock insurance companies owned by we're going over this again. Must be a reason, right? Stock insurance companies owned by shareholders who hold stock in the company. Shareholders may or may not be policyholders. Profits are distributed by dividends to shareholders. Goal: generate profit for shareholders, right? Mutual insurance companies are owned by policyholders who may receive dividends. Policyholders have voting rights in the company's decisions. Profits are typically returned to the policyholders in the form of dividends or lower premiums. Goal: serve the best interest of policyholders. The main distinction lies in the ownership structure. Stock companies prioritize shareholders' profits, while mutual companies focus on policyholder benefits. Fraternal organizations. Fraternal organizations or fraternal benefit societies are nonprofit entities that provide life and health insurance products to their members. These organizations are typically based on religious, ethnic, or professional affiliations. Didn't we just read this? And often engage in charitable activities as part of their mission. Characteristics of fraternal organizations include: membership is usually required to purchase insurance products. Members often have voting rights and can participate in organizational decision-making. These organizations offer insurance as part of their broader social and community-oriented mission. Fraternal societies must comply with the state insurance laws, but operate differently in traditional insurance companies in terms of structure and purpose. Examples of fraternal organizations include the Modern Woodsmen of America and the Knights of Columbus. I'm sure you've heard of both of those. Okay, self-insurers. Self-insured refers to the practice of setting aside funds to cover potential losses rather than transferring the risk of insurance company. Large corporations or government entities often self-insure for risks such as employee health benefits or workers' compensation. Key aspects of self-insurance include: the company assumes full responsibility for losses that occur. It may involve establishing a fund specifically designated to pay for claims. Self-insurance can save money in the long run for large organizations as they avoid paying premiums to third-party insurers. Companies that self-insure often purchase stop-loss insurance to protect themselves against catastrophic losses. Self-insurance is most commonly seen in large, financial, stable organizations with predictable risk exposure. Reinsurance. Reinsurance is a critical part of the insurance industry. It provides a way for insurance companies to manage and distribute their risks. In essence, reinsurance is insurance for insurance companies. Well, that makes sense. How reinsurance works. An insurance company, the ceding company, transfer part of its risk to another insurance company, the reinsurer. I think that's key. In exchange for a premium. Reinsurance allows the ceding company to take on larger risks while protecting its own financial stability. The reinsurer assumes the part of the financial responsibility for claims that exceed a certain amount. There are two types of reinsurance: facilitative reinsurance, FACU. Oh gosh, did I even say that right? I'm sorry. FACULATIVE. Facultate. I'm going to spell it out and you can write it out. How's that? FACULTATIVE. So you don't have to be smart to do this stuff. Heck, okay. You just have to be persistent. The reinsurer and ceding company negotiate terms for each individual policy. This is typically used for large or unusual risks. Treaty reinsurance, a prearranged agreement where the reinsurer automatically assumes a portion of all risks under the specified category. This is more commonly used in broader types of risks. Reinsurance is vital for maintaining solvency in the insurance industry and for spreading risks across multiple entities. Now, this is important. The law of large numbers in underwriting. I think it's all important because it's all going to be somewhere on a test, maybe. You just got to know it. Okay, so listen to this stuff over and over and over again. It's going to help you. The law of large numbers in underwriting. Insurance operates on a principle of law of large numbers, which allows insurers to predict losses more accurately by pooling a large number of similar risks. Okay, so the law of large numbers. We just did that, right? This principle states that larger pool of similar risks, the more predictable the losses will be. By insuring a large number of people or entities, insurance companies can spread risk and more accurately estimate the probability of future claims. Well, when the World Trade Center buildings came down, a lot of people died, right? All like that. Was it 3,000? But if the insurance company is spread around the United States, it didn't really affect them. Underwriting. Underwriting is the process insurers use to evaluate risk and determine whether to issue a policy, if so, under what terms and conditions. The underwriter assesses the risks associated with the individual or entity based on factors such as age, health, lifestyle, occupation, and more. The goal of underwriting is to price insurance policies fairly and to minimize the likelihood of financial loss for the insurer. Underwriting decisions are influenced by the law of large numbers, and larger pools of insured individuals allow underwriters to price policies more accurately based on the collective risk. Underwriters. So basically, a long time ago, when a ship was going from one port to the next, and they were worried about, if the pirates were going to take the load, or if the ship would sink, and John Hancock signed underneath the what they were going to insure. There you go, underwriter. Okay, life insurance basics. Life insurance is one of the most significant financial tools individuals can use to provide security for their loved ones after death. Okay, that says that. And also during life. Types of life insurance. Life insurance policies, but we're doing this for the test, right? Life insurance policies are generally categorized into two main types: temporary or permanent, term or whole life insurance. Each type serves a different purpose depending on the needs of the insured. Term life insurance provides coverage for a specified period, like 10, 20, or 30 years. If the insured dies during the term, the policy pays a death benefit to the beneficiary. Term life insurance is often chosen for its lower premiums compared to permanent insurance, but it does not build cash value. Whole life insurance, a type of permanent life insurance that provides lifetime coverage, as long as premiums are paid. Whole life policies they also accumulate cash value, which can be borrowed against or withdrawn by the policyholder. Premiums are typically higher than term policies, but they remain level throughout the insured life. Universal life insurance, a type of permanent life insurance with flexible premiums and death benefits. Universal life policies allow policyholders to adjust their premiums and death benefits to suit changing needs. These policies also accumulate cash value, which earns interest based on insurers' investment returns. By the way, just a little caveat to that, universal life policies can, when you call it lapse, because you didn't put enough in it. So be aware of that as an agent. Well, I don't know if that's going to be on the exam or not. Variable life insurance, a permanent life insurance policy that allows a policyholder to invest the policy's cash value in various investment options, such as stocks and bonds. The policy's death benefit and cash value can fluctuate based on the performance of the investment. This type of insurance carries more risk due to market volatility, but offers potentially higher returns. By the way, you must have a securities license to sell those. When you see variable, remember securities, like a Series 6 and 63 or a 7 and maybe a 65. I'm not sure about that one. But you must have a securities license. Group life insurance, often provided by employers. Group life insurance covers multiple individuals under a single policy. It is typically a term life insurance plan with lower coverage amounts. Group life insurance policies usually do not require individual underwriting, making them affordable option for employees. Man, I'm sorry. A lot of reading here. Policy provisions, options, and riders. Life insurance policies come with specific provisions and options that determine how the policy fluctuates. In addition, riders can be added to customize the policy to meet insurers' specific needs. 1. Beneficiaries. The persons or entity designated to receive the death benefit upon the insurer's death. Beneficiaries can be primary, first in line to receive benefits, or contingent, next in line to in the primary next in line if the primary beneficiary cannot receive the benefit. They died, right? Or they're mentally incompetent. You know what I mean? They're just not all there, or they're in a coma or something, all sorts of things. Beneficiary designations can also be revocable, can be changed, or irrevocable, cannot be changed without the beneficiary's consent. There's several reasons I can see that. Policy, I won't get into that, but later on as you come on board, we can discuss that later. Policy loans. Some permanent life insurance policies accumulate cash value that can be borrowed by the policyholder. These loans must be repaid with interest, but if not repaid, the outstanding loan amount is deducted from the death benefit upon insured's death. Remember this for the exam. And as you pass and you're in an organization and we go through all this stuff, right? Lots of things you can do. Settlement options. Settlement option dictate how the death benefit is paid to the beneficiary. Common settlement options include lump sum payment. The entire death benefit is paid in one lump sum. Interest only. The beneficiary receives interest payments from the insurers while the principal death benefit remains intact, or fixed period. The death benefit is paid in equal installments over a set period of time. Fixed amount. The beneficiary receives fixed payments until the death benefit is exhausted. Riders. Riders are optional provisions that modify the term of the life insurance policy to provide additional benefits. Some common riders include waiver premium. If the policyholder becomes disabled and is unable to work, this rider waives future premium payments while keeping the policy in force. Wow, that is an option. That is awesome. That is an awesome waiver. It will bring the price up, but it's an awesome thing to have. Okay. Accidental death benefit pays an additional death benefit if the insured dies as a result of an accident. might be a double indemnity, might be, well, I got to like double the value. That's still a pretty really good deal. A guaranteed insurability rider allows the policyholder to purchase additional coverage at specified intervals without undergoing further medical underwriting. That's cool. A child term rider provides life insurance coverage for insured children, so you can bundle it together, like husband, wife, kids. Okay, so anyway, or husband and kids and wife and kids, or whatever, significant other, however you want to write it. Life insurance premiums and proceeds. Premiums are the regular payments made by the policyholder to keep the insurance policy in force. Life insurance proceeds refer to the death benefit paid to the beneficiary upon the insured's death. Several factors affect life insurance premiums and how proceeds are taxed. Okay, factors affecting premiums. Age. Younger individuals typically pay lower premiums because they are expected to live longer. Health. Those in good condition often pay lower premiums. Pre-existing conditions, smoking, and lifestyle choices, risky hobbies, can result in higher premiums. Gender. Statistically, women tend to live longer than men, so their life insurance premiums are generally lower. I think that sucks, but it's, can't fight it. Policy types. Permanent policies such as whole and universal life tend to have higher premiums compared to term policies due to the cash value accumulation and lifetime coverage. Coverage amount. Higher death benefit amounts result in higher premiums. Occupations. Certain high-risk jobs like firefighters, pilots may result in higher premiums, or like underwater welder or stuff like that. You get the deal. They work with bombs and bomb squads, and I mean, you can imagine some of the things. Maybe a lion tamer. Taxation of life insurance. Death benefit. Generally, the death benefit is non-taxable to the benefactor as income. However, if the death benefit is paid in installments rather than lump sum, the interest portion of payments may be taxable. Just get it in lump sum. Cash value growth. Cash value on a permanent life insurance policy grows tax deferred. Policyholders are not taxed on the growth unless they withdraw more than total amount of premiums paid. Policy loans. Loans taken against the cash value are typically not taxed, but unpaid loans reduced the death benefit. Policy ownership rights and assignments. Life insurance policies give the policyholder certain ownership rights, which allow them to control how the policy is used, who benefits from it. Policy owner rights. Right to change beneficiary. The policyholder can change the beneficiary designated unless the beneficiary is irrevocable. Of course. Right to borrow against cash value. In permanent life insurance policies, the policyholder can borrow from the cash value provided it has accumulated sufficient value. Right to assign policy. Policyholder can transfer ownership of the policy to another individual or entity. This is often done in cases of estate planning or collateral for a loan, like in a business setting. I bought a big piece of machinery and you look like you're going to die, so let's go ahead and for the loan. Policy assignment. Collateral assignments. What? Policy assignment. It's weird. Collateral assignment. A policyholder can assign the policy as collateral for a loan. In the event of the policyholder's death, the lender is entitled to prepayment from the death benefit before any remaining funds are paid to the beneficiary. Okay, so you can split it up. You can split up the bill. Absolute assignment. This is a permanent transfer of ownership rights and giving the assignee full control over the policy, including the right to exchange the beneficiary to borrow against the cash value. I'm going to pause again. Kansas life insurance regulations. Kansas has a set of state-specific rules and regulations governing life insurance that agents must follow to ensure compliance and protect consumers. State-specific rules for life insurance. Kansas law regulates various aspects of life insurance to protect consumers from unfair practices and ensure transparency in the industry. These regulations cover policy provisions, sales practices, and advertising to ensure that life insurance products are sold ethically and that the consumers fully understand that the terms and conditions of their policies. I know we read this before. Key aspects of Kansas life insurance regulations include free look period. Yeah, we did. Grace periods, beneficiary laws, replacement laws. Advertising requirements, group life insurance regulations, suitability standards. I know we went over this before, but there must be a reason. Okay. Free look periods. Free look period is a consumer protection feature that allows policyholders to review their life insurance policy for specific periods after purchase. During this period, the policyholder can cancel the policy for any reason and receive full refund of any premiums paid. Kansas free look period is typically 10 to 30 days, depending on the type of policy. Individual life insurance policies, a minimum of 10 days. Replacement policies, Kansas law requires extended free look period of 20 days to give policyholders more time to reconsider their decision to replace an existing policy. The provision ensures that consumers have the opportunity to review the terms of their policy and cancel it without penalty if they're dissatisfied. By the way, just a caveat: a lot of agents don't even go over the policy, and so it kind of like hides what's going on. Don't do that. Just go over it with them. Okay. Grace periods. A grace period is mandatory time frame during which policyholder can make the late premium payment without policy lapsing. Kansas law requires that life insurance policies include a grace period to help policyholders maintain coverage if they miss a payment. And I know we said this before. In Kansas, the grace period for life insurance policies is generally 31 days from the date the premium was due. During this time, the insurance policy remains in force, and if the policyholder passes away during the grace period, the insurer must still pay the death benefit minus any unpaid premiums. Kansas law beneficiary laws. Or Kansas beneficiary laws. Sorry. Kansas life insurance law includes specific provisions regarding beneficiaries and the rights associated with them. Designation of beneficiaries. The policyholder has the right to designate one or more beneficiaries to receive the death benefit. Beneficiaries can be individuals, organizations, or entities. I know we said this again. And the policyholder can change the beneficiary designation at any time unless it's irrevocable. Yes, goodness gracious, irrevocable beneficiaries. If the policyholder designates an irrevocable beneficiary, the policyholder cannot change the beneficiary or borrow against the policy cash value without the consent of the irrevocable benefactor. That's like an irrevocable funeral trust. I've done those before. Okay. There's reasons, right? Some simultaneous death rule. Kansas has adopted the Uniform Simultaneous Death Act, which states that if the insured and the beneficiary die at the same time or under circumstances where it cannot be determined who died first, the policy proceeds will be distributed as if the insured outlived the beneficiary. This prevents the proceeds from going to the beneficiary's estate, which may not reflect the insured's wishes. That's pretty interesting, isn't it? Common law beneficiary rights. Kansas law also protects the rights of beneficiaries, ensuring that they receive the proceeds promptly after the death of the insured. If the insurer delays payment without good cause, the beneficiary may be entitled to interest on the unpaid death benefit. Cool. Replacement laws. Replacement laws are in place to protect consumers when they replace an existing life insurance policy with a new one. Kansas has strict rules to ensure that replacements are in the policyholder's best interest and not done purely for sales commissions. That's like twisting and churning. Key replacement regulations in Kansas include disclosure requirements. Agents must provide the policyholder with replacement notice explains the potential consequences for replacing existing policies, such as loss of cash value or new contestability periods. Comparison of policy. The agent must provide a written comparison of the new policy and the existing policy. including premiums, coverage amounts, and benefits. This helps the policyholder to make an informed decision. Extended free look period, as mentioned earlier, Kansas mandates 20-day free look period for replacement policies to give consumers extra time to reconsider their decision. These laws ensure that policyholders fully understand the impact of replacing existing policy and are protected from unethical sales practices. Life insurance advertising laws in Kansas. Kansas has strict advertising laws to prevent misleading or deceptive marketing practices in the life insurance industry. All advertisements, whether in print, online, or broadcast, must adhere to the following guidelines. I think we talked about this before. Accuracy and transparency. Advertisements must clearly and accurately describe the features and benefits of the policy being sold. Misleading claims or promises of guaranteed returns are prohibited. Disclosure of insured identity. All advertisements must clearly identify the insurer's issue of the policy. The name and contact information of the insurance company must be included. No misleading comparisons. Agents and insurers are prohibited from making your unfair or misleading comparisons between different policies or insurers. Any comparison must be based on factual and verifiable information. Use of testimonials. If testimonials are used in advertisement, they must reflect the honest opinion of the individual, and any compensation for the testimonial must be disclosed. Regulations by KID. The KID monitors advertising practices and takes disciplinary action against insurers or agents who engage in deceptive advertising. Group life insurance regulations. Group life insurance is typically type of insurance policy that covers a group of individuals under one contract. I think we said this before, often referred to as part of the employee's benefit package. Kansas has specific regulations governing group life insurance policies to protect consumers and ensures that they receive fair treatment. Eligibility. Group life insurance in Kansas is typically offered by employers, unions, or associations. Eligibility for coverage is usually based on employment status or membership in the organization offering the policy. Premiums. In many cases, group life insurance premiums are lower than individual life insurance premiums because the risk is spread over a larger group. Employers often contribute to the cost of premiums, making it an affordable option for employees. We'll talk more about this later once you get licensed and on the team, okay? Conversion rights. Kansas law requires group life insurance policies to include conversion option. If an individual leaves the group, they leave their job, they must be given an option to convert their group policy to an individual policy without requiring additional medical underwriting. Oh, that's really cool, isn't it? Now, this provision ensures that individuals can maintain life insurance coverage even after leaving the group. By the way, it'd probably be a little bit more money. Okay, keep in mind of that. Suitability and life insurance sales. Suitability standards in Kansas are designed to ensure life insurance agents recommend policies that meet the specific needs and financial objectives of their clients. Agents must act in the best interest of their clients and recommend policies that are appropriate for their situation. Key elements and suitability standards in Kansas include needs analysis. Before recommending a policy, agents must conduct a thorough analysis of the client's financial situation, goals, and insurance needs. Documentation. Agents must document their recommendations and explain why a particular policy is suitable for the client's needs. This documentation should be retained in case of a regulatory review. Please keep all documents. You can even just, read it and save it on a video if you want. Disclosure. The agents must provide full disclosure of policy features, benefits, premiums, and any associated risk. This helps clients make informed decisions and understand what they are purchasing. Ongoing review. Agents should periodically review their clients' life insurance coverage to ensure it continues to meet their needs. Please do that. Okay. I know a lot of people don't, especially ones that die or, they quit. So, especially if their financial situation or goals change. A specific licensing requirement for life insurance agents Kansas requires all life insurance agents to be licensed by state by KID. Of course. Gee, you just talked about this. To obtain a life insurance license, must meet the following: pre-licensing. We discussed this: pre-licensing ed, licensing exam, background check, continuing education. I already talked about all that, right? Okay, I'm gonna pause.